When an investor invests in international equities, they're actually taking two positions. The first position is in that international equity or that international equity index, and the second position is actually taking a position in the currency that those equities are denominated in. So for example, if you take an investment in a Japanese equity, you are long the Japanese equity, you're also long the Japanese yen and short the US dollar. And I think it's this second part that investors have been less aware of over the last few years, their exposure to foreign exchange through their international equity investments.
Now, how can currency fluctuations affect ETF investments? How can investors protect oneself from these fluctuations?
So over the last 10 years, investors have benefited from the 10-year decline of the US dollar in that time period. If you look at the USDX index, for example, that can show you in that time period how much the US dollar has declined. And so investors have benefited from a tailwind, so to speak, from the decline of the dollar versus international foreign currencies. However, we've been in a sideways movement for the US dollar since early 2009. And so investors need to be more aware of their exposure to the foreign currency in their international equity portfolio. Investors can protect themselves in a variety of ways. One is to overlay some kind of foreign currency hedge, and institutional investors do this all the time. The other way would be to invest in a currency product or to buy an international equity ETF that has the currency overlay built in.
So how can investors use currency hedged ETFs to manage risk?
So there are a couple of ways that investors can use these products. If an investor has a bearish view on the US dollar, then they should probably stay 100% unhedged because they're going to benefit from the decline of the dollar. If they're bullish to the US dollar, then they want to look to use a currency hedge product so that they will not be hit by the headwinds that a strengthening dollar would play on an unhedged product. There are also investment themes that they can transact, such as, say you like the fortunes and the future of Japanese equities, but you think that the Japanese yen is overvalued. If you're unhedged and that the yen does decline, your returns are going to be hurt, whereas a hedge product can help you to participate fully in the returns of the Japanese equities. You can do a similar argument for, say, Brazil or for Canada as well.